This video is on stocks and the stock market. So, when you are buying stocks or shares in the stock market, exactly what are you buying? You are buying a piece of that company. So, the shares of a company represents the different pieces of a company. So, how exactly does the stock market work? Well, a company will basically divide itself into pieces. Each one of those pieces is called a share. The company then will sell those pieces or shares to people who are willing to buy them. Those people who are willing to buy them are called investors. So, by selling those pieces of the company, by selling those shares, the investors' money goes into the company. And the thing that the investors receive is that share or partial ownership of that company. Uh, why do investors buy shares? So, investors buy shares because uh, when the company then makes money or profits, the investors, being partial owners of that company, will get the benefits. There are two different ways that the investors receive those profits from the company. Either A, the company can actually give the money directly to the investor through something called dividends, or the company might keep the money or do something with it that increases the value of that company. By increasing the value of that company, ideally the price of the shares will go up. So, how much the shares the investors have, um, the price of those shares will go up, and thereby the company uh, profits become the investors' profits. Let's give a quick little example of how this initially works. So, let's say we have this company called the Hamburger Hut. Uh, this is a restaurant that Mr. Lee owns. And let's say that the market has decided the company is worth $40,000. Okay. Right now, the company is a private company because Mr. Lee is the only person that owns it. Private companies, uh, usually only one or a few people own that particular company. So we have Mr. Lee's restaurant. Uh, Mr. Lee's decides to divide his company up into 1,000 pieces or 1,000 shares. So, because he's divided his company into 1,000 shares, each share is represents 0.1% of the whole company. And I get that just from the whole company being 100% divided by the 1,000 shares. Okay, so each share represents 0.1% of the company. Earlier, I mentioned that the market decided the company is worth $40,000. So 40,000 divided by 1,000 shares means that each share is worth $40. So Mr. Lee now has this restaurant that he's divided into 1,000 pieces. He decides to then sell 400 of those shares or 400 of those pieces to the public, and he's going to keep the other 600 shares for himself. So those 400 shares are sold at $40 a piece to investors. 400 shares times $40 per share means that Mr. Lee receives $16,000 from selling those shares. And this is a common situation that happens. when a private company goes public, they will sell part of the company to the public, but then keep part of it for themselves. And in this particular case, Mr. Lee has sold 40% of the company to the public and is keeping 60% of the company for himself. The reason that people, private individuals, often will sell a portion to the public, but not all of it, is so that they can still control the company. So here, Mr. Lee still owns 60% of the company for himself. So even if all 400 of these shares decided to that they wanted to do something, Mr. Lee still owns more than 50% of the company. So what he decides still goes for the company. Okay, so why would a company do this? Why would a company sell pieces of itself? There are two basic reasons why a company might do this. And both of those reasons has to do with bringing in money. One, the private individual who is selling pieces of the company might be trying to turn that ownership of the company into cash. So let's say Mr. Lee has a expensive personal thing he needs to do. Maybe he needs to fix his car. Maybe he has a hospital bill. So Mr. Lee personally needs money in his personal life. So by selling this 40% of the restaurant, he's able to turn that partial ownership of the restaurant into cash he can use right away. So that is one reason why this might happen. Second reason is Mr. Lee might have decided that he needs money in order to grow the business. Maybe Mr. Lee's Hamburger Hut is real successful and he wants to open up a second restaurant. Well, in order to do that, you need money. So maybe he's decided to sell 40% of this current restaurant in order to raise enough money to open up a second restaurant. So a company might sell these shares in order to raise money, maybe to expand its operation, open up extra stores, maybe to research something to improve their product, maybe to pay down debt that that company has, or some reason. The company needs money for some reason, so this is one way the company can get money. So, like I mentioned earlier, why do investors buy these shares? Well, investors buy these shares for the purpose of making money or profits. So there are a few different ways that the investor can make money from buying shares. One is the company can, when the company makes profits, the company can give those profits directly to their investors, directly to their shareholders, through something called dividends. And all dividends is cash given directly to the shareholders. Second way that investors can make money off buying shares. If the company makes profits, makes money, and decides to keep that money, this usually causes the price of the shares to go up. And when the prices of the shares go up, the value of those shares that the shareholder owns has gone up. And if the shareholder wanted to sell those shares to somebody else, they could for a higher price. Option number three, and this has become more and more popular since about 2010. A company can make money, and instead of giving it directly to the shareholders or just keeping it in the bank, the company can actually go and buy back some of its own shares. When the company buys back some of its own shares, that means there are fewer shares out there, which means each share represents a larger percent ownership of the company. To look at my previous example with Mr. Lee's Hamburger Hut, initially Mr. Lee divided this company into 1,000 pieces. So therefore, each piece represented 0.1% ownership of this restaurant. Now, if the restaurant makes a bunch of money and then decides to use that money to buy back 500 of these shares, well, if it buys back 500 shares, which would mean there'd only be 500 shares left out on the market, that means each share goes from being worth 1% of the whole company to being worth 0.2% of the whole company. So this is how, if a company ends up using its money to buy back shares, how that actually will benefit the investors. So that's the general beginning of how shares work in the market, how a company initially becomes a public company. Let's go over these vocab words again, just to formalize it. So a share, that's a noun, and a share is a partial ownership of a company. An investor is the people or organizations that own those shares or buy those shares. This is also called a shareholder, or somebody who holds a share in the company. The stock market, a noun, is just the place where shares are bought and sold. Markets in general means a place where things are bought and sold. So a stock market is a place where stocks or shares are bought and sold. This can be a real life location or a digital location. When the stock market first started, this was an actual physical location. In the US, that physical location was in New York and called the New York Stock Exchange. And in this real life location, people would go there and buy shares from each other and sell shares to the people who were there. Nowadays, a lot of this stuff is done digitally on a website. Initial public offering, which is usually just called an IPO. An initial public offering is when a private company first divides itself up and sells pieces of itself to the general public. So initial is because this is the first time it's happening. Public is that's who gets to buy it, everybody in the public, and they are offering shares or pieces of their company. Okay, so when somebody buys a share, what they're buying is one, partial ownership of the company. Two, uh, a share means that the owner of that share is entitled to a piece of the dividend. So if Apple decides to give $50 billion in dividends in cash directly to its shareholders, those 50 billion will be divided evenly amongst each of the shares of the company. So that share entitles you to a piece of the dividend, and each share entitles you to one vote. So in Mr. Lee's Hamburger Hut example, since he divided up the company into 1,000 pieces, that means there are 1,000 total votes. Because he kept 600 shares for himself, that means he has 600 votes, and the whole public combined has 400 votes. So this is the reason why many times when a private company goes public, they will try to keep at least 50% or 50.1% of the shares for themselves, so they can always outvote everybody else, thereby having complete control over the company, even though they sold part of the company to the public. That being said, all 1,000 of these shares will receive the exact same amount of dividends. All right. So we talked about how do you make money in the stock market or through buying shares. How do you lose money? So there are a few different ways that investors or shareholders lose money in the stock market. One, this is one way of losing money. If the investor buys a share and then the price of the share goes down, and then the investor decides to sell the share, well, they have definitely lost money in this scenario. So if somebody buys a share of Mr. Lee's Hamburger Hut for $40, later on the market decides that these shares are not worth $40 and are only worth $30, that investor, if they go and sell that share, they can only get $30 for it, so they have lost $10 on that share. Other ways that you can lose money in the stock market or by buying shares. One, let's say that the company initially divided itself into 1,000 pieces. Later on, though, the company goes and sells more shares because the company is selling more shares to the public. That means there's more shares out there. So that means each share is now worth a little bit less. In this particular example that we were talking about, where we initially had 1,000 shares, each worth 0.1% of the company, let's say you personally go and buy all 400 of these pieces for yourself. So you own 40% of this restaurant. But then Mr. Lee, because he controls the company with his 60% of the votes, he decides the company is going to go and sell another 1,000 shares to the public. All of a sudden, there are now 2,000 shares out there. So instead of each share being worth 0.1% of the company, it now becomes 0.05%. So if a company decides to sell more shares, then the value of your share that you already own goes down. Another way that you lose money in the stock market, uh, actually, let me go with this vocabulary word first. So, an ask price. There are actually at least two different prices for the shares of a company. There's the ask price and then there's the bid price. Ask price is the price uh, to buy a share. The bid price is the price that you will get if you sell your share. This price, the ask price, is higher generally than the bid price. The difference between those two is called the spread. Because the ask price is higher than the bid price, if you buy a stock and then immediately sell it 0.1 second later, you immediately sell it, you will still lose money because of the difference of these two, or because of that spread. The person who's getting the spread is the stock market. So that place where you are buying and selling shares, they charge a fee, or they charge this spread in order to help bring together people who want to buy and people who want to sell. So, back to how do you lose money in the stock market? Well, that spread is one way that you lose money in the stock market. And there's basically no way to avoid the spread. Two, when you are buying or selling, they will generally charge you a flat fee for that trade. $4 for the trade, $8 for the trade, something like that. A lot of times these are a flat fee for your trade. For us regular people, almost regardless of the size of your trade. So if you want to buy 10 shares or 100 shares, they will still charge you the exact same, let's say $4 for that trade. At really large numbers, they might charge you more. Like instead of buying 100 shares, if you're buying 100,000 shares, then the flat fee goes up. But for us regular people, it's generally this very fixed fee. All right, so that's generally how the stock market works. That's how a company first becomes a public company, and how you buy and sell pieces of that company, how you lose money, how you gain money. Let's spend some time looking at some of the vocabulary and features of a specific company. So, when you're looking at a specific company, that company has a ticker symbol. The ticker is just a symbol that is used to represent that company in the stock market. So, for example, Walt Disney Company, their ticker is DIS. So it's basically just an abbreviation for the company. Each company operates in a sector, or each company operates in an industry. This is basically the area the company works in, or the type of company it is. So, for example, Netflix is their sector is considered communication services, and their industry is considered entertainment. These are just categories that the company falls in. A lot of times, companies are compared to other companies in its industry or its sector to judge how good or bad of a company it is. Uh, Next word I want to talk about is this one, market capitalization. Market capitalization is how much the company is worth. So if you take how many shares there are out there times the price per share, that would be the market capitalization. Another way of thinking about this is how much would you have to pay to buy 100% of the company? These are market capitalization categories or sizes of company categories. If the market capitalization is over $200 billion, we call that a mega size. For a large size company, has a market capitalization between 10 and 200 billion. Medium, small, and here's micro. In general, the smaller companies are more volatile or changes more, bigger ups and bigger downs compared to your bigger size companies. So when you are deciding whether or not a company is worth buying, there's a few different ways you can look at that company. There's a few different ways to measure the value of a company, whether it's a good or bad buy. One way is the PE ratio. The PE ratio is just the price of the share divided by the earnings per share. You can have either a trailing PE ratio, trailing means looking backwards, or you can have a forward PE ratio. Forward is obviously looking forward. So if you take its current price and divided current price per share divided by its earnings over the last 12 months per share, then that creates a trailing PE ratio because you're looking at the past 12 months of earnings. If you take the current price and then divide it by how much earnings you expect that company to make in the next 12 months, so you're looking into the future, then that would be considered a forward PE ratio. The trailing PE ratio everyone can generally agree on because that's looking into the past, so you know how much money they made, you know how much earnings they had over the past 12 months. For a forward PE ratio, you have to kind of guess or estimate their earnings. So therefore, your forward PE ratio is only as good as that guess. Another way of thinking of PE ratio is how much would you have to pay for $1 of that company's earnings. So if you do this math right here and you get a PE ratio of 12, then that means you are paying $12 when you buy that stock for every $1 that that company is making in earnings, in profits. Let's do an example here. So let's say we have this company, company Q. One share of that company costs $25 right now on the stock market. The company made $40 million last year, and the company has 20 million shares out there. Okay, so the price per share is 25, said right here. Earning per share is $2. This is earning per share, so this is earnings divided by shares. So they earned $40 million last year, and there are 20 million shares, so 40 million divided by 20 million is 2. Because we're looking at earnings in the past, this is a trailing PE. So the price per share, 25, divided by the earnings per share of 2, means that this has a trailing PE of 12.5. One way to figure out whether this is a good PE ratio or a bad PE ratio is to look at it compared to the historical average for the S&P 500. S&P 500 is just the 500 biggest, most important companies in the US. So compared to the average PE for those companies over a period of time, would the 12.5 be high or low? That's one way to look at the PE ratio. Another very common way of looking at a company to see whether it's a good deal or bad deal is the PEG ratio. The PEG is the PE ratio divided by growth. That's why PEG. If you do the trailing PE divided by how much has the earnings grown over the last year, then this is called the trailing PEG ratio. If you take the forward PE ratio and then divide it by how much do you expect the earnings to grow over the next 12 months, since both of these things are looking into the future, this would be called a forward PEG. Once again, this your forward PEG will only be as good as your guesses about its future earnings and future growth in earnings. Here's an example of the PEG. Let's say that company Q, well, it made $32 million 2 years ago. And then we said last year it made $40 million. Okay, so that means it went up by $8 million from 2 years ago to 1 year ago. So if it goes up, if it starts at 32 and then goes up by 8 million, that means it's going up 25%. So since its trailing PE is 12.5 and its growth over the last year was 25%, its trailing PEG, 25 divided by 12.5 divided by 25, its trailing PE would be 0.5. A common way of seeing or looking at whether this is a good PEG or a bad PEG, a rule of thumb, is that a PEG of 1 is considered a fair value. Anything lower than that is considered underpriced. That means like a good time to buy it. A PEG of greater than 1 is considered overpriced. Too expensive. These are obviously rules of thumb. And there are cases where having a PEG of greater than 1 is still a good price to buy it. And sometimes a lower than 1 is not a good time to buy it. But those are just general rules of thumb. There are a lot of different ways to measure whether or not a company is a good buy at that particular price. Here are a lot of others. So there's no one way that everybody looks at it. There's no one guaranteed way that's going to definitely make you money. Okay, one more that I do want to talk about though is dividends. Dividends is a large part of the money people make in the stock market. Once again, the dividends is the money that the company is giving directly back to the people who own those shares. And it's usually said in a how many dollars per share. So you might talk about a dividend of $3 per share. So each person who has a share would then make $3 or get $3 from the company. A dividend is not guaranteed. A company does not have to actually give it to you. In fact, even if when you buy it, the company is expecting and telling people that they're going to give $3 in dividends for the next year, at any time that company can just decide, nope, we're not going to do it. So dividend is never guaranteed. However, there are lots of people who buy companies specifically for their dividend. One key measure related to dividend is dividend yield. So if you take how much that dividend is per year and then divide it by the share price, you get this thing called dividend yield. So if I spend this much money buying this share, how much will I get back in a dividend per year? And this is usually represented as a percent. So a 6% dividend yield means for no matter how much money you put in when you buy shares, you are getting 6% of that back as a dividend for the year, assuming they pay the dividend that they said they would pay. So, because this is a percent of getting your money back every year, often this dividend yield is compared to other yields for other more stable assets, or just compared to the yield of other assets. Because CDs and bonds, it's listed right when you buy it as this many percents that you're going to get. This dividend yield is sometimes compared to that as a way to sort of think about, is this a good yield or a bad yield? Last thing I want to say, the stock market is a future facing place. In general, the price of stocks don't necessarily reflect what just happened recently. Instead, the price of stocks in general is reflecting how investors feel about the future. What investors think the future will look like. And a rule of thumb, a general rule, is that in general, the stock market is a reflection of how investors feel the economy and that company will look like about 6 months into the future. This is why a lot of times uh, the way the stock market goes up and down is different than how regular workers are feeling about the economy. During a recession, when people are losing their jobs and regular workers might be feeling crummy about the economy, the stock market could actually be going up because if the stock market is predicting already that 6 months from then, the economy will already be improving. So this sort of explains the disconnect often between the stock market and how regular people feel about the economy.